Welcome to today's Explainer. We're diving headfirst into what is essentially a financial detective story. We're going to uncover the absolute truth behind business performance using the incredibly powerful tool of variance analysis. If you've ever looked at a company's budget and thought, wait, why do the final numbers look totally different from the plan? Well, you are in exactly the right place. We are going to unpack exactly how managers trace those discrepancies right back to their source.
Here's our roadmap for the breakdown today. We're going to cover 1. Expectations versus reality. 2. Tracking material cost variances. 3. Measuring labor and ratios. 4. Unpacking overhead expenses. 5. Analyzing sales performance. And finally, 6. Taking action on variances. Let's get into it.
Section 1. Expectations versus reality, the baseline. Okay, let's dive into this.
Every good investigation needs a solid baseline, right? In management accounting, that baseline is our expectation, which we call the standard cost. Think of it as the benchmark. It's a measurement of resource usage set under defined, efficient conditions. Basically, it's what the product should cost. Now, on the flip side of that, we have the reality, the actual performance. This is the cold, hard truth of what actually happened on the ground and what it actually cost us out of pocket.
And that gap? That brings us to the very mystery we're trying to solve, the variance. A variance is simply the difference between that standard cost expectation and our actual performance reality. When actual costs are less than what we budgeted or our income is higher, we call that a favorable variance. That's a win. But when it costs us more or we earn less than we planned, yeah, we've got an adverse variance on our hands.
Section 2. Tracking material cost variances. The procurement mystery. Let's make our first actual stop on this factory tour.
Heading straight to procurement, we break down our total material variance into 2 sub-variances. First up is the material price variance. This looks squarely at the purchasing desk. Did we pay more or less per unit than planned? To find out, we take the standard price minus the actual price and multiply that by the actual quantity purchased. Notice that emphasis there. It's based on what we bought, not what we used. This lets management instantly isolate how the purchasing department is performing. Second, we have the material usage variance, which shifts focus to the factory floor. Did we waste material? We take the standard quantity we should have used for our actual production, subtract what we actually used, and multiply by the standard price.
When you map this out visually, it's pretty incredible how price and usage interact. The standard cost forms that inner boundary, but look at the shaded areas. The top rectangle shows the excess cost caused completely by paying a higher price per kilogram than expected. Boom, that's your price variance. The rectangle on the right, that shows the extra cost we incurred simply because we used more kilograms than the standard dictated. That's your usage variance. Put them together, and they form the total excess cost over our standard. It's just a brilliant way to visualize the math.
Section 3. Measuring labor and ratios. The shop floor reality. Let's transition from raw materials over to the human element.
Just like materials, labor has its own subvariances, but there is a vital distinction here you absolutely cannot miss. The labor rate variance measures if we paid a different hourly rate than expected. You take the standard rate minus the actual rate and multiply it by actual hours paid. But for the efficiency variance, which measures if the team took more or less time than expected to produce the output, we take the standard hours for actual output minus actual hours worked, multiplied by the standard rate. Why the difference between paid and worked? Because of the third piece, idle time. If machines break down, workers are still getting paid, but they aren't working. Idle time variance quantifies that specific cost of non-productive time by taking actual hours worked minus actual hours paid times the standard rate. Add the rate, efficiency, and idle time variances together, and you get your total labor variance.
To truly keep a pulse on shop floor productivity, management uses labor ratios as their vital signs. The efficiency ratio, standard hours for actual output divided by actual hours worked, tells us how fast the team is moving compared to standard. The capacity ratio, actual hours worked divided by budgeted hours, measures how many hours they spent actively working against the budget. And the production volume ratio combines both to show overall output against the budget. Monitoring these helps management spot bad trends before they blow up into massive adverse variances. They also look closely at the labor turnover rate, the number of leavers requiring replacement divided by the average number of employees, just to see if constant workforce churn is what's actually dragging down these efficiencies.
Section 4. Unpacking overhead expenses, the factor utilities. Now we shift our focus to the unseen costs.
The overheads. These are the expenses keeping the lights on and the machines running. But before we get into the heavy overhead formulas, I want to prime your brain. Turn this dense math into actual business questions. Ask yourself, did the fixed overhead cost more or less than we expected? And did our employees work faster or slower? Keep those real-world questions in your head and the formulas will make perfect sense.
Let's start with variable overheads. By definition, these fluctuate right alongside production. So we measure two things. First, the expenditure variance. Did we spend too much per hour worked? We take the standard rate minus the actual rate times the actual hours worked. Second, the efficiency variance. Did we take way too many hours to finish the job? We calculate this by taking the standard hours for actual output minus actual hours worked times the standard rate. This relies directly on labor hours, because if workers are inefficient and taking forever, we are running those machines and burning through variable overheads for longer too.
Now for fixed overheads under absorption costing. The absolutely crucial point here is that fixed costs shouldn't change with production volume. That's why they're fixed. Therefore, the expenditure variance is wonderfully straightforward. Just budgeted fixed costs minus actual fixed costs. Easy. But the volume variance? That is where the real investigation happens. We take the actual units produced minus budgeted units times the standard fixed overhead rate per unit. This measures the overhead we actually absorbed into our units versus what we budgeted. And that volume variance is driven by two underlying components. Capacity, did we work the hours we planned? And efficiency, did we actually produce what we should have during those hours?
Section 5. Analyzing Sales Performance, the storefront. We've thoroughly investigated the factory, so let's take this outside.
It's time to see how our final products are performing out in the wild. When revenue doesn't match the budget, we are generally hunting for two main culprits. First, did we charge a different price than planned? That gives us our sales price variance, which is the actual selling price minus the standard selling price multiplied by the actual units sold. Or, culprit number 2, did we sell a different quantity than budgeted? That's our sales volume variance, calculating the actual units sold minus budgeted units sold, all multiplied by the standard margin.
Actually, scratch that. Let's pause for a second. This is a massive watch-out moment for standard costing. Look really closely at the definition of standard margin used in that sales volume variance. The way you calculate this variance completely transforms depending on your accounting system. Under absorption costing, that standard margin represents the standard profit per unit. But if you were using marginal costing, it represents the standard contribution per unit. Grasping this subtle nuance is absolutely essential if you want your financial reporting to be accurate.
Section 6, Taking Action on Variances, Solving the Case. Let's see how this all builds together.
We've crunched the math, we've calculated the variances, but how does management actually make decisions with this data? It comes down to a fundamental concept, management by exception. This is exactly why this whole detective process matters. A modern business generates a terrifying amount of data. Variances act as a filter. They allow leaders to basically ignore the departments that are working perfectly to standard and instead ruthlessly target their time, energy, and resources on the anomalies, the exceptions that require immediate attention.
But listen, you can't just blindly chase every single variance. You always have to apply the cost versus benefit test. There's a fantastic example of this. Imagine your variance report highlights a $5,000 adverse material usage variance because of waste. Okay, you could fix it by forcing the workforce to spend way more time carefully processing those materials. But if that extra careful time adds $6,000 a month to your labor costs, it's just not worth it. The cure is literally more expensive than the disease.
And that leaves us with the ultimate question for any business leader. A variance analysis is an incredible tool. It acts like a compass, pointing directly to exactly what happened and where it happened. But data alone doesn't fix a business, does it? It requires human insight to decide, are you actually willing to change your internal processes, renegotiate with your suppliers, or retrain your workforce to fix the root cause? Thank you so much for joining me on this explainer. I hope you walk away feeling totally empowered to apply this investigative toolkit to your own operational mysteries.